Helps when you push the go live button, doesn't it? Yes, it does. Oops. What am I talking about this week? So this week's all about market knowledge. Market knowledge is very important because obviously things are changing day to day. And as we're noticing that things are changing in the marketplace, we have to ask ourselves, how can we insulate our decision making from the variability that we see in the market, right? At this point in time, there's a lot of, well, I want to call ups and downs, but I guess there's not really a lot of down, is there, at the moment? It's mostly just up in terms of interest rates and inflation and yeah, how do I want to phrase it? There are a lot of moving pieces in the economy right now. Pieces that are always there, but that usually we don't, as individuals, really focus on, right? Whether that's the inflation piece or whether that's the money supply, or two things that are very closely related, mind you. But these are things that currently are a concern to, I think, both casual observers and professional investors alike, right? And obviously, one of the problems with these macroeconomic factors becoming important considerations is that they can be kind of chaotic, right? To borrow a word from the financial advisor community, right? They introduce a lot of volatility. And volatility is the enemy of business people everywhere because it makes it hard to predict, to make predictions and have those predictions turn out accurately. Ooh, that was weird. Excuse me. All right, there it was. Right, so the volatility can affect the accuracy of your predictions as an investor. That's what makes investing in time periods such as this one more challenging than, say, what it was like 2 years ago, right? And that means that as an investor, you need to find ways to ensure that your analysis or your predictions about what is going to happen, to ensure that they are, more accurate. Then also to make sure that you understand how your predictions will be affected by those macroeconomic factors, such as inflation, right? What they mean for you and your investment, as well as for, your potential customer or clientele base, right? Your tenants, essentially the people you'll be renting to, how that will affect what they want out of the market. And also, if you're planning on buying or selling, right, then how that's going to affect what your buyers and sellers are looking to do, right? So that's a pretty daunting challenge, right? How do I look at the market and analyze a property and feel comfortable, putting down my $200,000 down payment or my $1 million commitment with a mortgage, When I'm seeing the prices go up and down, some prices have fallen as much as 30%, right? Others are up 5%. It's crazy. Things are kind of all over the place when I go and look, say, at the MLS, for example. So what's going on, right? How do I continue to evaluate properties and deals that are on the market, with everything that's going on in the world? And a large part of that obviously comes down to fundamentals. Um, I've likened investing to exercising or working out many, many times in the past. And I think that the analogy holds. If you focus on the fundamentals, then the rest kind of falls into place, right? If you are going to the gym and you're weightlifting and you focus on making sure you do your form and you're tracking your reps, then either your reps or your weight should increase over time, right? As long as you're exercising with proper form, those things will increase over time, right? And so similarly, if you're analyzing the properties, um, and you're looking at all the fundamentals, you're looking at the four streams, right? You're looking at all of your expenses, and you're looking at all of your withholdings, and you're putting that all together to create a holistic picture of how the asset is going to perform, then you're doing pretty good in that you've considered all of the numbers that you need to run that property or that asset as a business, right? And to try to generate cash flow from it. That is your first line of defense, your first and your best line of defense. Obviously, if you analyze something, fundamentally using the prevailing interest rate and it's profitable, then it's profitable. Now, it may not be profitable in 3 years as market conditions change, right? And that's the fear, and that's what I'm talking about. But you know that today it is profitable, right? So one of the things that you can do with that knowledge, obviously, is you could purchase the property. Well, sorry, you'd have to reanalyze the property using a fixed rate rather than a variable rate, right? Include the additional cost of the fixed rate mortgage. And now, if at this point in time you have a property that's profitable today, well, if you have a fixed rate mortgage, then it'll be profitable for the next 5 years, right? And so that's one way to mitigate your risk, right? Is to know what you're buying and go in strong with a good business case. Pardon me. Right, a lot of the trouble that investors are starting to run into in Toronto. Some people already have, although I don't know that you'd call them investors, but is people are getting squeezed because they have an unpredictable asset, right? They have an unpredictable financial product. They have a variable rate mortgage. And obviously, for many years now, you've looked like a genius with a variable rate mortgage. And this is the thing. You always will until you don't. I don't want to say that a fixed rate mortgage is better than a variable or vice versa. They have their uses and they have their time and their place, right? But in general, a fixed rate mortgage is superior to a variable rate mortgage for one reason alone. As a business, right, it guarantees that this expense is going to remain the same for a fixed period of time, right? It gives you some predictability in a world where obviously it's not always easy to predict things. So that's one consideration. And some advisors or brokers would say, well, now is not the time to get a fixed rate mortgage because hopefully the rates are going to go down. And there is no way to know that. What I can know is that at the current rate, my property is currently profitable. If the rates go down, cool, it becomes more profitable and I can look at refinancing options, right? I can always break a mortgage early. I'll just have to pay the penalty. And depending on who the lender is, the penalty for breaking the mortgage early can be prohibitive or it can be pretty affordable, right? So that's just that's got to be a situational evaluation or analysis that you do, right? Is now I'm in the moment, I've got my property, my portfolio, whatever, and I fixed the interest rate at, let's say, 7%, and now it's fallen back down to, I don't know, 4, right? What is it going to cost you to break that mortgage versus how much is it going to save you on payments? If you're saving $50 a month, that's $600 a year. You got 3 years left to go, and it's going to cost you $1,500 to break the mortgage. You'll have to decide whether you're willing to go through the hassle of the paperwork for that extra $300 you'd save, right? The difference between the $1,800 you'd make over those 3 years and the $1,500 it costs you to break the mortgage. That's a decision for you to make, right? And obviously, if that difference gets a lot larger, it's obviously a much easier decision to make, right? But if hey, I'm making, I don't know, just make the numbers easy. I'm making $200 a month on this property, right? At the current interest rate, or at the interest rate that I originally mortgaged the property on, then I'm still making $200, whether the economy goes up, down, left, right, or sideways, but within reason, of course, within reason. And so that's really the plan, right? Is to understand this economic asset as best as you can, and understand how it's going to be deployed in the market, and then make use of it. So what does that look like moving forward, since we're already in a higher interest rate environment? It's not a high rate environment yet, since we haven't made it to double digits, but it is a higher rate environment. Well, obviously, first, that means looking through your portfolio. Do I have variable rate mortgages? If I do, why did I choose those variable rate mortgages? If there isn't a good reason, if it was just what was doing at the time, or what have you, then I need to evaluate, well, what would it cost me to turn my variable into a fixed rate and now have a predictable cost basis for my asset? For most people, it's probably not worth it to refinance from the variable into the fixed at this point. You might save some money. It's hard to say, because it's hard to predict where interest rates will go from here. Assuming they continue to increase, which they might, right? If you take the media or the government seriously on inflation, it stands to reason we're going to have more inflation beating measures put in place, right? And so that should raise interest rates, right? Now, there are other factors like capital flows and debt servicing costs that the government is also going to be balancing against fighting inflation. And so it's not clear that they will necessarily continue to raise interest rates as aggressively as we saw them do last year, right? That being said, if we look historically, the last time we had a high interest rate period in the 80s, it was not a simple 1 or 2 year fix. It was a problem that carried on for the better part of a decade. Interest rates remained high for the latter part of the 1980s, and they began to fall in the 90s. But the falling interest rates were met with stagnation in asset valuation, right? So houses and things of that nature were not increasing in value for much of the 90s. And so, again, that's a concern, right? If you're an investor and you've analyzed your property and you've understood, the 4 streams and all of your expenses and everything, then your how do I want to phrase this? Your assets should be positioned to cash flow in the market. The reason why that is super critical, even if that cash flow amount is very limited, right? Even if it's, maybe $100 a month or what have you. The reason why that's critical is because if we enter another interest rate environment, like the 1990s, then these assets will not be producing money for you from the passive appreciation stream. You'll only have cash flow, active appreciation, and principal recapture, right? So you need a property to be cash flowing ever so slightly, at least, so that if you find yourself in a position where there is no longer any appreciation on that property, it's still a profitable asset for you to hold. And the hope is that between your cash flow and your principal recapture, that it's actually a productive asset. That is, it's giving you a return that is comparable or better than that which you could get somewhere else, say the stock market, right? And the stock market averages about 7% per year. So we have a good baseline to compare to, right? If I put $200,000 in real estate and getting back 14,000 or more per year, or would I be better off to take that $200,000 to the stock market, where in an index fund it'd be reasonable to expect about $14,000 on my 200 grand every year, right? Pardon me. So understanding those fundamentals of our property analysis, that's going to give us the confidence to say, yes, this is a good deal. No, this is not a good deal. Yes, I want to move forward, or no, I don't, right? Does this fit my strategy and my criteria or not? The other thing that we need to be looking at, right, especially if you're looking to grow or expand your portfolio at this time, right, is you need to be gathering market knowledge, market data. I'm not sure how you want to phrase it, but you need more information about the market. Currently, the way that the market, I guess the way that the market works in Canada, just in general, is that we have a fairly opaque real estate market here in Canada. So, property transfers are not a matter of public record. We don't publish tax delinquency. So some of this information that's available in the United States, for example, compared to Canada, is lacking. And that has its pros and its cons. So one of the cons is that it's much harder to go to a given neighborhood and collect economic data for yourself on how that neighborhood is doing. And what I mean by that is, if I take a community, for example, I've got Lisgar in Mississauga here. Lisgar is a community. It's got 28,000 residents. It's got 2 high schools, Catholic and a public. It's got 3 elementary schools, and blah, 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 right? And we give you all sorts of demographic information. The average age in the neighborhood's 45 years old, and et cetera, et cetera, et cetera. What I can't tell you about Lisgar is what percentage of the properties are mortgaged versus owned outright. I can't tell you what percentage of those mortgages are delinquent, right? I can't tell you what the average household debt in that area is, for example, all sorts of things like that. Now, probably household debt is probably not a stat that'd be easy to get in America either, but the others are, and they allow you to evaluate how healthy a neighborhood is, right? Obviously, a neighborhood where most of the mortgages are in good standing is a neighborhood where the people are doing well and the prices have not gotten too unreasonable for the people that live there. Here in Canada, you would not be able to find that out. In fact, it can be quite difficult to even know what something sold for. And this is where really developing your market knowledge becomes key. Either working with a realtor or taking the time yourself, although I recommend working with a realtor, at least in part, to help you get some of the comps. You're going to want market comps on the properties that you're looking at. And what you're probably going to want to do is you're probably going to want to drill down to 1 or 2 neighborhoods that you really want to be invested in, and you're going to want to get as much market data as you can about that neighborhood. How many houses were sold, how many, if it's probably an irrelevant stat, but how many housing starts were there, right? Did anybody build any new property in that neighborhood? What's the average sale price? What's the top end sale price? What's the bottom end sale price? What's the median sale price, right? You want to know these numbers so that when you're looking at a property today, you can compare it to the alternatives in that neighborhood, right? Because really, I'm going to pick on Lisgar again, just because I mentioned already. Like, if I'm going to move to Lisgar and I said there's 25,000 people who live there, right? I can be the person who paid the most to live in Lisgar. I can be the person who paid the least to live in Lisgar, or I can be any of the people in between, right? Obviously, as an investor, I would prefer to be the person who paid the least to be there, right? The less I pay to be there, the more profit I'm going to make. So when you're looking at a given neighborhood, right, if you're looking and you've got a house that you've identified, as a target, right, you can now compare that to the other properties in the area. If they're comparable, right, then are you paying a fair price? Obviously not everything is comparable. If you're looking at the one apartment building in the neighborhood and it's, I don't know, it's an apartment building, so let's say it's $25 million, right? And you're sitting there going, oh, well, the average cost of a home in this neighborhood is $800,000. Like, okay, it's a tricky comparison because an apartment building and a home is not the same thing. I mean, one would hope that your apartment building is costing you substantially less than $800,000 per unit to compare to the stock that is available in the neighborhood. Right. And generally, of course, it would be, but this is what you want to be comparing to, right? Because even just that little thought experiment of the $800,000 property versus $800,000 per unit in your apartment building. Well, you don't want to be paying $800,000 per unit in an apartment building. You'd hope to be getting it for cheaper, right? But that's going to determine basically how much cash flow can you make there, right? In a community that is currently buying $800,000 properties is currently paying $620 or so thousand mortgages. At the prevailing rate right now, about 6.25% or so. That's about $655 per $100,000 borrowed on a 25-year amortization, right? So, pardon me. What's that? So 6 times 8. What's that? 40. Oh, betray myself. 42. 40. 48. Oh, still too early in the morning. Right. So $655 times 8, right? So about $800,000 mortgage. It's about a $5,000 a month payment, $4,800 a month mortgage payment, right? And so that means that person to live in that home, it's costing them $4,800 plus you got taxes. So $4,800 is probably going to become 40. Let's call it $5,000, $200 a month on taxes. Might be double that, but let's just say. Then obviously in utilities, you throw 100 in for electricity, 100 in for gas, $50 in for water, kind of thing. So now we're at $52.50 or so per month. You add in a couple miscellaneous because you got to repair stuff and things of that nature. So $52.50. Probably between, so it's costing a homeowner in this community a hypothetical $5,500 a month to live in a home independently, right? Like a home that they own, about $5,500 a month or so. That's giving us market data because now we know what the alternatives are for our tenants, right? If we are buying the local apartment building and your average person in this community is paying about $5,500 a month to live there, then we have a baseline that people in this community like spend $5,500 a month, right? That's That's $60,000, $70,000, $2,000 a year or so on housing, right? So these are people who are earning on average about $210,000 a household if we're following the 33% rule, which probably most households are not anymore, but roughly. And so that tells us as well, first of all, tenants will pay less than owners will. right? That goes without saying. So you as a landlord already know, well, I can't get $5,500 per month in rent, right? That's for sure, right? But you do know that they can't live in a house for less than about $5,000 per month in this neighborhood. So you know that your rent is going to come out, maybe not at $5,000 a month. It might be $4,500 or $4,000 a month, but your rent is going to come out near that number, right? So now we have a baseline established for what it costs to live in the area that we're investing in, right? And this is very important so that we can say this asset is correctly priced, right? That is not the purchase price of the asset, but the rental price of the asset. The rental price is correctly priced so that when I purchase this property, I will be able to charge this amount to rent out the property, right? And you can get rental comps in addition to market data to confirm what rate you're going to be able to charge for these properties, right? When you put that together, right, now you're going to know roughly, right, an accurate number for your cash flow. So whether that's $100 per unit per month or whatever it is, right? And that target's up to you, though. $100 per unit per month is a great beginning target for sure. Just trying to get cash flow and understand all the principles at play, right? But now that you have that, now you can go and say in the market, is this property priced correctly? And discipline becomes one of the most important skills, I guess. It's not the word I'm looking for. Attributes, skills, I don't know. But discipline becomes one of the most important tools in your tool belt, right? Because you now are in a market which would be referred to as this is kind of a buyer's market, right? We were in a seller's market for years. Now we're kind of in a buyer's market, or we're transitioning into a buyer's market, right? Where sellers want to sell more than buyers want to buy. And so for the last few years, everybody has been trained to have very little discipline, right? Offer higher than before. I remember people talking to me about, trying to buy property and how can you when, they always go over asking and you should make your offer, over the asking price so that you're competitive and this and that. And that's the kind of garbage advice that you get from realtors and things of this nature. And I say garbage advice. It was good advice in the sense that if you wanted to buy a house, these were the market conditions. So they're trying to help you to get the carrot on the end of the stick, for lack of a better way to put it. It's bad advice. And the reason I call it garbage advice is because there's never a time in life where you should give up discipline. Okay, so people are panicked or there's a low supply of things, you should still be disciplined, right? And so I think it's bad advice. I think if Torontonians in general hadn't indulged in this nonsense, which was largely stoked by realtors, right, which were all, make these blind offers and go win 100,000 over and blah, 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 I think the prices would have been less out of control. They still would have, it's a hot market, so prices are still going to be high, but you get people excuse me. I guess you just get their buying temperature up, right? You get people so excited that now they're throwing money and, carelessly, and they shouldn't be. You need to be very disciplined, right? You're going to decide what your margin is going to be. How do I want to put this? Okay, so to make the analogy really, really simple. If you're in retail, right, you buy, I don't know, milk, right? You buy milk for $1. You sell it for $1.30. You make 30 cents on every unit of milk that you sell. You have a 30-point margin. 30-point margin, pretty standard margin for retail. Most retail places you go to are operating on 30% margins. Some a little bit less, some more, depending on whether you're buying luxurious stuff or not, right? Luxury will tend to have higher margins, right? But most places are operating on about a 30% margin, right? So if you go into a store and you see something is $100, they paid about $70 for it. because they're working on a 30% margin. Now, it's good to understand that math. The store says, hey, I'm going to pay this price. I'm going to sell for this price. They take that product into their store and they put it on the shelf, $1.30 for milk. And you know what? You and I, we both walk into that store. I don't drink milk myself personally. Makes me my stomach not feel good. So I'm not a milk drinker. I don't really consume this stuff. I don't cook with it either. I guess baking sometimes. I'm not a baker, but if people in my life bake, maybe I'll consume some milk. Basically, I don't buy milk. So I go in that store, $1.30, $1.70, 25 cents. Aaron doesn't care. I don't want milk. I guess you can talk about arbitrage, but that's getting away from the point. So there's not really a price that entices me to buy milk. But you might walk in the store and say, hey, $1.30, good price. I'm going to buy. Or you might say, you know what, $1.30, that's too expensive. Milk was on sale 3 weeks ago for $1, and I'm going to hold off, right? Either way, it doesn't matter to the store owner. The store owner has said, I'm going to make 30 points on this. So whoever comes in who's ready to give me $1.30 for this milk, they can have the milk. And anybody who's not ready to give me $1.30 for the milk, too bad, so sad. You'll have to come back some other day because right now milk is $1.30. And I think not enough people bring that mindset to real estate, right? A lot of things in the world of business are take it or leave it. Yeah, that's the best way to put it, right? When you go to the grocery store, as an example, to carry on the example, it's take it or leave it, right? You want something or you don't. This is the price, you take it or you leave it. Now, obviously, in real estate, because the prices are so much higher, we negotiate. So it's not quite take it or leave it, right? We negotiate. You could negotiate with the grocery store too about the apples, right? I'm sure if you went into a grocery store today and instead of buying the regular, $3 or $4 worth of apples, you went to go buy $500 worth of apples, which might be every apple they have in the store. You could probably speak to I don't know who it would be, the produce manager, the store manager, whomever, and say, hey, look, these are $1.99 a pound. Give them to me for $1.89 a pound since I'm buying so much. And you know what? They'd probably give you that deal. So you can negotiate if you're bringing enough buying power, and with a home you are, because you're bringing $1 million with, an apple or milk. You're usually not. And that's how the store gets its 30% margin, right? Is they go buy that product in bulk and negotiate a better discount than you as an individual would. And then they make the difference between that discount and the prevailing market rate. So you get to do the exact same thing with your real estate, right? Obviously, you can't sit there and say, this is my price. I'm never going to budge on it. Screw the market. This is what I'm selling for. Because there is a market, right? And your property has value within that market. And you are able to augment, you're able to change the value of your property in the marketplace by, making it more desirable, telling a story, selling it, right? Having incredible sales skills, etc. But there's an upper limit to how much value you can add to this property, right? But if you have discipline, and the discipline is really, it's less on the selling than it is on the buying, right? The buying is where you need to have the discipline to go in and say, hey, I figured this property is profitable at this price. Okay. Now I understand, Mr. Seller, that you would like $899.9 for your property. But I've done the math and I've run through the numbers, and I can't make a profit on this if I pay anything over $825. I understand that that's $75,000 less than you were hoping for, Mr. Seller. But for me to make this investment work, I can't pay you more than $825. If you are happy with that $825, I'm happy to draw up an offer today. But if you would like to keep looking in the market for someone who can afford to pay $899.9, then by all means, that's your prerogative to do so. If in the future that's not working out for you and you'd like to come back, please give me a call. Here's my contact information, blah, 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 blah. I'm investor ABCXYZ. All right. Please give me a call in the future. But that's what I can do. And you got to be firm about that, right? Because First of all, there's a couple things. First of all, the seller probably has more flexibility than you do, right? Because the seller owns the property, and so therefore they've been there to accrue some gains from owning that property over the last few years. So let's just, for example, say somebody's owned that property for 10 years. Well, housing prices in GTA have effectively doubled in 10 years. So anybody who has a house that they're selling that they've owned for 10 years that is not selling it under the duress because they've overfinanced it or something like that, right? That person should have about 50% equity in that property. So if we're talking about $1 million, $899, let's say they should have about $450,000 of equity in there. Now, since most people are regular people, they're not investors, they're not business owners, they're not particularly wealthy. Most people don't touch $450,000 in their day-to-day lives, right? Most people don't. That's just a really large sum of money for most people. And in fact, it's such a large sum of money. It's such an unfathomable sum of money for many people that the difference between $400,000 and $450,000 in the minds of your average person is basically nil, right? It's a lot and then a lot plus a little bit more. That's how people think about that, right? So when you're approaching the seller has $450,000 approximately, right, in this example, of margin to work with that they could theoretically, take or give a bit of a discount on and still be satisfied, right? Again, for your average seller, if they put $450,000 in their pocket versus $400,000 in their pocket, hey, everybody would prefer 450. That's obviously clear. But for a lot of people, 400 is not that. It's not that big a loss to them to go down from 450 to 400. And so you as the buyer are in a position to say, hey, I need you to come down from making 450 to making 400 to get this sale done today, which may be worthwhile to that person who's watching, $6, $7, $8, $10,000 a month coming out of their account, to service this property that they own, right? They may say to you, you know what? Yeah, I could take my chances, and in 2 months' time, as an example, maybe I'd get it sold, and at a cost of $10,000 a month, that's an extra 20 grand, and blah, blah, and there's uncertainty. And a lot of people might take you up and give you a discount. They might come back and say, hey, 50 is too steep, but how about I give $25,000 discount, et cetera, whatever. The details and specifics aren't important. What is important is the principle, right? We're going into the market doing our analysis. And I think where a lot of people run into trouble is they do the analysis on the market as the market currently exists, and they say, oh, okay, I can't find a property that is profitable, and this is really difficult. I'm having trouble finding assets that I can acquire. And what they don't understand is that, investing generally, real estate investing especially, is a creative endeavor, as are all things that people do. You need to create assets. You don't just find and buy them. Anybody could do that. That's called stock investing, right? Pre-created assets that you just buy. Right. With real estate, you're creating an asset. You're taking a home that maybe was a liability to somebody for 30 years, and now you're turning it into an apartment for 1 or 2 families to live in that is hopefully going to pay you every single month. Right. So that creativity needs to be applied. Obviously, when you're looking at a house and trying to determine its potential, or property, try to determine its potential, right? But also that needs to be used when you look at an asset or a potential asset, something you're looking to purchase, and you say, oh, this thing loses money, this is a stinker. Well, okay. But what would it take to make that a winner, right? I think real estate investor thinking is very much possibilities thinking, right? How would I make this a winning situation? What would I have to pay for it? Or what circumstances would need to emerge? How do I make this a win for me, or potentially a win for both myself and the seller, right? And in a lot of cases, that means, hey, the price is a little bit too high. You right now in the Toronto market, it's probably the price is too high, right? And so you need to come in and say, hey, this is the price that is okay. If we're talking straight negotiation, right? If you're actually speaking to the seller, which most of the time in Canada you won't be, you'll be speaking to their realtor. But if you're speaking to the seller, I mean, you can explain to them, hey, look, I invest in real estate, and I'd be happy to buy this property off of you, but I can't make money at this price. And if I can't make money, I can't afford to buy your home. So really simply, we need to find a price where I can make a little bit of money, you can sell your house and you can make a little bit of money. Everybody can walk away from this deal happy. If you're looking for a deal where you get the most money possible for your property, then you're going to sell your property at a price where the next person can't make money off it, which is fine, right? But you need to understand that's a much less motivated buyer than I am, right? And it may take time for that buyer to come to market and want to take your house off your hands. I'm here standing in front of you today telling you I have access to the funds to buy your property now, but in order to make that happen, you need to work with me on the price here, right? That's a conversation you can absolutely have with a seller. And sellers will be open to a degree. It very much depends on the seller. You're going to have to gauge disposition, right? There's a not insignificant number of people who are sellers, who are working with a realtor, who don't like negotiating. They don't really like dealing with people, and you're not going to probably have very much success with them. There's another type of seller, much less common than the first type there, who hates realtors. They want to do everything themselves, and they'll happily talk to you and negotiate. Some of them will negotiate and they'll move on price. Some of them will not. But those are people that you have to talk to. And then there's a whole vast swath of everybody who's in between, right? But you have an advantage as a buyer that they don't have as a seller. As a seller, I've already got my product that I need to sell. And my advantage, what I can do is I've got this margin because I've owned it. I've got this equity in it that I can make bigger or smaller to try to entice buyers to purchase my property. So that's the position I'm in as the seller. As the buyer, the position that I'm in is obviously I don't have that leverage. I don't have that equity. But what I do have, one, I have discipline, right? Hopefully. And two, I have options. See, I'm buying a property, not your property. As a seller, I'm selling my property, not a property. I'm stuck with what I got. But as a buyer, I buy whatever the hell I want. So if you wanted to, right, you could figure out that profitable price on every property in the neighborhood. Well, I say there's 25,000 people in Lisgar, so there's probably like 5 to 10,000 homes in Lisgar. If I wanted to, I could make an offer on every single property there. I mean, obviously, this is a bit ridiculous for illustrative purposes, but I could make that offer now on all of those properties at a price that I know is profitable for me. And, if I hit 100 listings, 1,000 listings, whatever it is, right, some small proportion of those people are going to get back to me and say, you know what, your offer was insultingly low, counter offer with an offer that is still reasonable per my analysis. Or maybe we like your offer, you know what, we'd like to get rid of the property, are you still buying, et cetera, et cetera. So you're in a position where use a bad analogy, but you're the hot girl at the bar right now because it's a buyer's market and you're a buyer. You're the hot girl at the bar, right? There is a lot of attention being thrown your way, and you can go out, you can go out and get some free shrimp for dinner tonight, and tomorrow night you can go out and get a nice steak dinner, for free from a different feller, and a third the night after that, right? Because you're the person who's in demand, right? Similarly, you're a buyer right now in a high interest rate environment where interest rates continue to climb, and a lot of people have been lulled into a false sense of security where they were financing their properties on these variable rate loans. So they've seen their financing costs increase by 30-40%. Let's see, I'm just looking at my table here. So people who bought in at 2.5% 25-year AM were paying $448 per $100,000 borrowed. And at the current interest rate, they'd be paying around $625 to $640 per $100,000. So that is a 33% or so increase in borrowing costs, which is quite large, right? If you break it down, the recommended or even the stress test amount limitation for income versus property ownership It's about 30% of your income goes to your real estate. So if you were spending, let's say, $3,000 prior to the last year's increases or so, right, at that 2.5% interest rate, then you'd now be spending $4,000, right? Because an extra 33% is an extra $1,000 on my 3,000. You're now spending $4,000 a month, right? Which is an additional $12,000 a year, right? Now, $3,000 per month is $36,000 a year. So $4,000 is now $48,000 a year, and that that $48,000 a year compared to the 36 you're paying for, well, 36 is a third of your income, right? Which means that 48 is actually half of your income, right? Assuming your income didn't change in that time period. So you're now being squeezed really, really hard by the cost of that housing. So you're incentivized. You want to get rid of the property. And I am now a hawker at the bar, the buyer, who maybe a year or two ago I was begging you to give me a chance to buy your property, but now I'm not in that position anymore. So I understand the market. I get it. You want to get rid of your property. This is my price. And there are enough people who want to get rid of their property that I can say for sure my price, set it at a point that you consider to be profitable, and now move forward. And when I say set at a point that is profitable, I'm trying to avoid specifics because markets are different, right? Depending on where specifically you are, the numbers that you're actually going to be able to get in terms of margin are going to be different, right? But for example, if I'm in Toronto, let's say I probably wouldn't want to buy a house that doesn't make me about $50,000 immediately, right? So if I'm looking at a house that is, let's say, valued at, right, I believe the fair market value of that property is $800,000. I might push to buy it for $750,000, $775,000, something on that order, right, to give me that margin, so I can say for sure on day one I bought this property, I had that $50,000 of equity in there from getting a discount from the seller. Right. Obviously, seller doesn't want to give me that discount, but they might be desperate to sell the house. Right. And when I say desperate, I don't mean, oh, they're desperate, so let's take advantage of them. That's not what I'm trying to get at. What I'm saying is that they're motivated to sell, but you're not motivated to buy. Right. You can sit on the sidelines. The difference between buying today and buying in 2 months is not that great for you. Right. But for them, that might be huge because, again, this has now grown from 30% of their income to 50% of their income. Like, they are being drained. And so the cost of holding it for 2 months might be equivalent to, I mean, it won't be $50,000 to be fair, but it might be close enough that they're willing to pay you that to get out, to wash their hands, to have the comfort. There are people who cannot sleep at night, right? Knowing that their mortgage payment is coming due and they don't know how they're gonna pay for it, plus send the kids to school and everything else, right? And there are some folks who would gladly pay $50,000 to have that problem go away and have peace of mind so that they can sleep and get back to being productive and taking care of their families and themselves, right? So it is difficult to value or let me phrase that a different way. You can't evaluate what other people value. It's one of the core problems of communism, is that communists assume that you can sit down and say, well, this is worth this much, and that it's the same for everybody. And of course it is not, right? Things are different for everybody's in a different position, right? If you're the type of person who's very, very anxious and who hates having this money hanging over your head, you might be willing to pay a lot of money, what might seem like an unreasonable amount of money to most people, in order to avoid that anxiety because it causes you so much discomfort, right? Some people are very risk averse and they would not want something like that hanging over their head. Other people are very risk tolerant and they don't mind at all. Bring it on, right? So depending on who you're talking to and what their disposition is going to determine what they're willing to accept in terms of a profit or a loss, right? And so understanding your property in terms of, what are the comps to determine the actual value, what are the costs to actually run and control this asset, right? And then figuring out, so what would I need to charge to make a profit, and then at the prevailing market rates, if a 2-bedroom is renting currently for $2,500, what price do I need to pay to make sure that that $2,500 turns out to be profitable for me, right? When you've calculated all those things and now you know those numbers, you can now go to your seller and make offers, right? And the great thing about knowing those numbers and knowing your market data is, if I know that on an $800,000 property, I need to collect $5,500 in rent to profit, right, to make some cash flow, that is going to be true on every single $800,000 property, right? The numbers are going to work out the same. So now it's just a matter of evaluating the property. Hey, is this a good property? Does it have good bones? Whatever. Does it have the physical features that I look for in a property? All right, maybe multiple units, multiple entrances, whatever it is, right? Because if so, these are the numbers, and then this is approximately the price we need to hit. And now you can go make your offer. Obviously, it's going to be a bit of a lowball offer. But you could go make your offer, and hopefully, right, much like the young man who goes to the dance, you might not dance with the first girl you ask to dance, but if you keep asking, somebody's eventually gonna dance with you, right? And same thing here. In terms of buying property and acquiring assets, there's probably no better time, really, because there's very little competition, right? The only other people who are really active out there's 2 categories of people. People who they don't really have another choice. They got to move for work or their job, or because financial reasons dictate, right? And investors are probably the only 2 people who are really buying at the moment, right? Certainly with any volume. Just because of the market conditions. And that means that every seller is now in like fierce competition with their other local sellers to get a deal done and move their property. And so you can come in with a position of leverage, right? And again, as long as you know your numbers, because that is very key, right? So that you're making offers that are profitable to you, that you can confidently close on and say, yes, I've made some money here, then you can go out and make that offer 50, 100 times until somebody sees the value in your offer, right? Because they're valuing something other than just the bottom line dollars and cents, right? And then you've got a deal that can make you profit. And you could easily grow your portfolio 2, 3, 4 properties in this time period, depending on your financial situation and depending on how aggressive you are, right? Obviously, a good margin to target is like 5 to 10%. Real estate is not retail, right? So you can't get that. I mean, you can get a 30% margin, but it'd be very rare. You used to see 30% margins or close to on some of these like pre-construction condo developments where people were getting in, buying units for $350,000 kind of thing. And 2 years later, when the condo development was like live, those units were selling for like $550 and stuff like that. So people were seeing those kinds of crazy margins. But in general, in real estate, that's an anomaly. Well, I shouldn't say that. There are ways like through the development process that you could see returns like that. And that's kind of what people were taking advantage of with those that pre-construction condo stuff. But in general, if you're buying things like in the open, single family home market kind of thing, you're probably not going to see a 3% margin. I think a lot of builders build on a 10% margin. So to give you an idea, right? If Mattamy Homes, pick a name, goes and builds a new property and they sell it to you for $1.2 million, it cost them $10.50 to build, kind of a thing, right? Or maybe almost 11 to build. So that is the perspective, the mindset that you need to be armed with, as we move further into 2023, and as the market continues to move sideways at best. These are kind of the principles or the guideposts that you should be following, right, to to start dialing in your market understanding, your market knowledge. And again, when I say dialing in your market knowledge, I don't mean something broad, like, for example, Mississauga. Mississauga is not a market, although it is tempting to talk about it as though it is. Mississauga is a market, quote unquote, but in real estate, it's a series of smaller, more local markets, right? If you're familiar, right? I mentioned Lisgar, Erin Mills, Streetsville, Meadowvale, Arundel, whatever, Clarkson, etc. So there's all these smaller communities or neighborhoods that are local and they have different valuations, and you need to understand, which market is which, and then understand in this area what is a property worth, and then start making your offers on that basis. And if you want your market focus to be Mississauga, right, you could absolutely do that, but you need to understand it on the basis of each individual neighborhood, one at a time, because your offers are going to be local to each area, right? Lisgar, Erin Mills, Clarkson, etc., etc. So, and that's true of any large metro center, right? Even medium size. I mean, even if I go to a place like Sudbury, which is relatively small compared to Mississauga, there are still different communities, right? And understanding which one you're investing in is important, because some are worth a lot more than others, right? And as long as you're doing this math and you make sure you understand and you're comparing it to that community, so you can actually cash out at the prices you're calculating, right? Then you should find this market is actually advantageous to you, as long as you can practice that discipline of saying no when they get away from your price. And that's not to say you can't negotiate a little bit, right? Personally, I would always throw a price that's a little more optimistic than what I'm hoping for, and see if we can't battle back to a price that I'm happy with, right? So that they feel that you're giving a bit of give or some flex in the negotiation as well. But that's down to negotiation style, and that's down to how you want to present yourself to people. The bottom line is just make sure you understand your product so that you know what to pay for, right? Like a grocery store understands when they buy a carton of milk, I've got 2 weeks, 3 weeks. I don't know how long milk lasts for in the grocery store, but I've got however many weeks to sell this milk before it goes bad. And I know that it's costing me 2 cents per day that it spends in that fridge to run the fridge, and et cetera, et cetera. So I know I need to get rid of that milk in, I don't know, let's say if it's costing you 2 cents per day in the fridge, I need to get rid of that milk in 15 days or less, right? Or else I stop making money on the milk. I don't know if that's exactly how the numbers work in the grocery store, but all I'm saying is they understand their product, right? And so the grocer does not go and buy 10,000 cartons of milk in a grocery store that sells 1,000 cartons a week, right? Because they know that at the end of their 2 weeks, at the end of their 15 days, they're still going to have 8,000 cartons left over, and that milk is going to start to spoil, right? So they prepare their products appropriately for the market, and you too must do the same thing, except your product is going to be a nice rental apartment or apartments or units, however you want to call it, for some people who want to rent short-term, long-term, whatever it is. And so just go into it with that mindset and that understanding, and I think really get away from this mindset of investing, because I think people, even though people are using the words wrong, you can't get away from the fact that people use words wrong. And I think people use the words investing completely wrong. And they associate it with, risk and loss, or at least the potential for loss and all these things. And, obviously everything in life has the potential for loss. But if you're doing your math right, there's no more risk in buying your investment than there is in anything else that you buy. Right. And I think a lot of us will go on Amazon or whatever, and we'll spend a couple $100 with absolutely no stress or anxiety, right? Which is all money that's being straight up lost. Like if you're worried you're going to buy an investment and you might lose 1% on your investment, which, is scary. And certainly if you invest $1 million, it's not nothing. Right. But if you're worried about that, then I don't understand why you pull out your credit card, go to Amazon or Louis Vuitton or whatever, and you'll spend $1,000 on consumer goods, which is all, it's 100% loss, right? You can't sell any of that stuff. It's crap. It's basically from them to you to the garbage. That's what that stuff does. And you won't sweat it at all, right? Most of us will not sweat that at all. So I very much think that there's a, we don't think accurately enough about these things, and it inspires a lot of fear. I think that fear really, for a lot of people, they become afraid, so they become undisciplined, and then that compounds the problem, right? And really what investing of any sort requires us to be dispassionate, right? To sit back and divorce ourselves from our feelings, our anxieties, our fears, and say, what is the brass tacks in terms of dollars and cents? What makes sense here? And oftentimes what is in the market does not make sense. And so we all need to acknowledge that the market is what it is. It's not perfect. And so we need to look at that market and say, okay, look, at this price, this makes money. And then move accordingly. Again, I'll pick on one more example before I go, because I know I'm already over time. But obviously now Elon Musk owns Twitter. And I remember talking to those of you who were on the seminar, when it was initially announced he would buy Twitter. And I remember saying, I don't know if this deal will go through, blah, 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 blah. It's a bit of a process. But one thing you need to understand about these types of purchases is, they determine a price that they think will be profitable, and then they go back and forth in what's called due diligence, and they negotiate with the seller over the price based on their findings as to whether or not they believe that the company, the underlying asset, can justify the price paid for it, right? And so Twitter has now changed hands. Elon paid whatever, 46 billion or something. Excuse me, I don't know what the final number was, but something like that. And basically, Twitter was a very strange case because he really didn't negotiate around the price. Pretty sure it was kind of like an FU purchase, like just, I don't like you, screw you, shut up, take the money, and let me do this better type of purchase. And so I don't know if Elon Musk is actually going to make any money off of that deal. That would be an example probably of a fairly undisciplined buy on the part of Elon, but it's not super duper clear. He's a very smart guy, so it's very hard to say. But what is clear, right, is that Twitter wanted a higher price, right? At one point, Twitter was upset. They felt that he should pay them more. Then they backed off, and then they felt that he should just pay them what was promised. It became a whole thing because Twitter's kind of a weird company. But in general, Twitter was looking to extract more value from him, and he had to hold the line. A lot of investors in his situation, right? If you were to take someone like Warren Buffett would definitely take the preferred investor, preferred share approach, where he would say, no, you know what? If I'm coming to your company, I recognize that it's worth, let's say, $50 billion, but you're going to let me in at the price of $40 billion because for me, that's the only way I'm willing to do business with you guys, and you want me more than I want you, right? That's what Warren Buffett does. And obviously, you're not Warren Buffett. Warren Buffett can command really stupid discounts because Warren Buffett is good for the business. He's good for the brand, etc. Just saying your company is associated with Warren Buffett is going to be good for your company, right? And obviously, you don't have the same kind of cachet. But you have to still apply the same principle that Warren Buffett would apply, which is, I want a discount. I want a discount. So take that as your mentality. I want a discount. Right? When you go to the grocery store, the shoe store, the computer store, the game store, the wherever you go, right? Maybe not the titty bar, but everywhere else, right? When you go to these places, do you say to the cashier, hey, can I pay full price for this? Or do you always look for coupons, sales, discounts, right? You should be doing the exact same thing with assets. So, but the first step in being able to do that is you need to actually understand what the asset is worth, right? You can't ask for a discount on something if you don't know what the price should be in the first place, right? If I walk into Longo's and they're selling me, I don't know, mangoes for $5 a mango, if I ask for a 50-cent discount to get those mangoes for $4.50, then I don't actually know if I've done well. Like, can I go across the street to No Frills and get a mango for $2.50? Or do mangoes actually cost $5, and so my 50-cent discount's a really good deal? I won't know until I've gone and seen what other mangoes cost. And it's the same thing with real estate. If I see a property that's listed for $900,000 and then they say they'll sell to me for $850,000, I don't know whether I've got a good deal or not until I look at my alternative options, right? What other properties are worth $900,000? Do they look the same? What properties are worth $850,000? Do they look the same? Am I buying a property that looks exactly the same as another $850,000 property, but being told I'm getting a $50,000 discount from the $900,000 initial price? How am I supposed to know? And the answer is I can't unless I have market knowledge. So that's why market knowledge is so crucial, is to actually spend some time looking at the properties, understanding what they need to look like financially to make you money, and then also understanding what the market is can afford you in terms of sell price, buy price, what's available to you. And so that's the knowledge that is really going to allow you to now come in and with some savvy and with some confidence say, hey, this price is too high, I need a lower price. And to have the discipline to walk away and say, you know what, okay, it's just not the price that I need. There will be another. Excuse me. So that's all I've got to say for this week. I think I've been looking at the market a decent amount lately. There's a lot of opportunity out there. There's not a lot for sale. That's true. But if you understand the market, then I think there is a lot of opportunity. Obviously, inflation and just sort of poor economic prospects push up rental prices. Rental prices were up as much as 20% in parts of Canada over the last year. Like rents did really well. Landlords have done quite well this last year. So things are there. It's not all doom and gloom, and it's very, very positive from an investor standpoint, as long as you've got that discipline. Or hey, shoot, actually, even if you don't have the discipline, if you just already had some real estate, you can increase your rents, assuming you're getting tenant turnover. Since the landlord tenant board will still cap you out at 2% or whatever it is. So, excuse me, it's good. It's good, and I'm hopefully maybe even we can do some stories on here where we start looking for some properties, and if you want, you can send them in. We can analyze them together and kind of take a look, not just at where we think the fundamental numbers should be, but also, hey, where maybe does that place an offer for us? Where would we start the negotiation and that sort of thing? So that's something maybe we can explore in the coming weeks if you guys are interested. Either way, I hope you have a fantastic, fantastic day. Thank you for taking the time out to join me this morning, or if you're watching this on YouTube, whenever you got around to it. And if you have any questions or comments, now's a great time. Send me an email or give me a call or reach out to me, contact me anyways, leave a comment, whatever you want to do. And then I'll try and get back to you as soon as I can. And until then, you have a great week.